Number 8. So let's take a quick look at the calculation. So vehicle wear and tear per section 11E. Taking a cost or an amount divided by 5 times 11 over 12. There's insurance here, which is an amount times 100 over 115. So that's to exclude VAT times 11 months. And there's a fuel amount as well. Okay, so let's go and see what they say in number 8. So on the 1st of November 2021, Stripes purchased a new Honda, which is a passenger vehicle, for 368,000 rands. That is 320,000 rands and VAT of 48,000. And they gave it to the company's general manager to use as a company car. So the first thing I want you to just see here is if we say November 2021 to September 2022, that is 11 months. So let's quickly go and take a look here. So that's that 11 over 12 there, which they did in the calculation. So that's correct. But what have they used here? They've used the cost excluding VAT divided by 5. The cost excluding VAT. So they tell you that there's a useful life of 5 years, but they used the cost excluding VAT. Is that correct? So I'm going to remind you. So this is the cost of the vehicle. Cost ex VAT, 320,000. The VAT on that is given to us as being 48,000. So it gives us the total, including VAT, 368,000. So if we have to consider what section 23 capital C tells us you need to exclude the cost of VAT if you could claim it. So how much would you pay? You would pay 368,000 for this. And how much input tax could you claim? That 48,000. Could you claim it? No. Why not? Because this is a motive car and input tax is denied. So how much does this cost you for income tax purposes? 368,000. So they were incorrect to use the amount excluding VAT because they would not be able to claim it. Okay. Then the insurance and the fuel. They paid a monthly insurance premium of 2,875 including VAT, and they paid 26,000 excluding VAT on fuel. Okay, now let's take have a quick discussion on this 2,875 for insurance. 2,875. Total ex VAT, VAT, total including VAT. Okay, so the total including VAT is 2,875. So I can just quickly work out the VAT. 2,875 times 15 over 115 gives us 375. So the total excluding VAT is 2.5. Okay. So how much for section 23C? How much did they claim? So I'm just going to say here, how much do they pay? They pay 2,875 a month. How much input tax can they claim? Can they claim that input tax of 375? Now the first thing is, remember, you can't say that no, they can't because input tax is denied. That's incorrect. Input tax only denied on renting and purchasing a motor car. This is insurance. It has nothing to do with the motor car. It's insurance on the motor car, sure, but it's not the motor car. It's insurance. You can claim the VAT. But how much VAT can you claim? How much VAT can you claim? You can only claim 90% of it. Because this general manager works for the entire business. And only 90% of this business is taxable. Sorry, so you claim back 337.5. So that means that this costs you 2537.5. So that 2537.5 is the cost excluding VAT, 2,500, plus 10% of the VAT, which you couldn't claim. Just as another little summary for you, 2537.5. So 10% of the VAT. Again, taking it all the way to the top of the question, because 10% of this is rental income. And they tell you in this question, the general manager is, manages all aspects of the company. Fuel is 0 rated VAT, so you could only claim 90% of that, but it's null, so that's fine. Okay, and what do they not do here? The output tax on the fringe benefit. Now, why am I worried about the output tax on the fringe benefit here? Because remember, the output tax on the fringe benefit results in an extra expense which you can claim under Section 11A. How would they calculate that output tax on the fringe benefit? Just as a reminder, it's 368, the amount including VAT, times 100 over 115. You don't apportion it or anything weird like that. Times 0.3% because we couldn't claim the input VAT. Minus 85 rands because he's responsible for all the maintenance costs. Times 15 over 115. Times the number of months. And I'm just showing this to you. And times 90%. Because 90% of it is apportioned. Remember, the rule says output tax is never apportioned except for indemnity awards and fringe benefits and basically change in use. So I'm just pointing it out to you guys because just as a bit of a quick little recap and a reminder of that from a VAT perspective. Okay, then we have rental income from note number 9. So they give us the rental income from October until August, and then for September. So 20 units times 8,000 times 11 months, and then 17 units times 8,000 times 1 month. Okay, and then they give us a building write-off, 80,000 divided by 40 years times 12 over 12. Now really, when I look at this, I know that this is wrong because we know that there's no such an allowance like that. So let's go and see what they talk about in note number 9. So it says Stripes owns a block of flats with 20 units. The block of flats was purchased new from the developer in 2009. So they own at least 6 residential units. So that means they can claim Section 13(6). And it was cost 9120 million, which is 8 million rands plus VAT of 1120. And the company depreciates all buildings over a useful life of 40 years. So that's what they're doing there. They're claiming depreciation on that. This is quickly going to have a little discussion here. So first of all, I just want you to see that they're using the amount excluding VAT there, which is in any case incorrect. Because this is residential accommodation, so they would not be able to claim the VAT. So divided by 40 is incorrect. So where is Section 13(6)? Okay, what is Section 13(6) in this case? It would be 9120 times 5%. That's what they would be able to claim. Why the amount including VAT? Again, it's this whole Section 23(c) concept. The cost ex VAT is 8 million. With the VAT on that was 1120. Gives us 9120. So how much would they pay? They would pay 9120 as a cash outflow, so I'm putting that in brackets. How much input tax would they be able to claim on this? Nothing, because it's exempt. It's used for residential accommodation. So that would mean that the cost would be 9120,000. So that is what they would be able to claim. Okay, then they tell us these units were all occupied for the entire year of assessment by its factory workers. And they charge 8,000 rands a month, excluding VAT. That's correct, because it's residential accommodation, it shouldn't be VAT, per flat. On the last day of the year of assessment, 3 of the employees had not yet paid their rent for September 2022, and this was only collected in November 2022. Okay, so what has this accountant done? This accountant has said for August until October until August, everybody paid and everybody collected all the money. That's for 11 months. But for September, 3 of the units didn't pay. So we only calculated for 17 units. So they're doing this on a cash flow basis. This is wrong. You should calculate it on 20 units because gross income is the earlier of receipt or accrual, and it has already accrued to us. Okay, then we have the admin building, section 13.6. Right, so that's first of all incorrect. It should be section 13 quin, and it's 10 million plus 4 million times 5%. So it says, Stripes purchased its admin building in 2005 for 11.4 million, which is 10 million plus VAT of 1.4 million. Okay, so first of all, section 13 quin, which is the correct section, only applies or applied from 1 April 2007. So thus no allowance on that part can be claimed. Then they say Stripes erected an additional office block of offices next to the existing building. The block was erected at a cost of 4.6 million, which is 4 million plus VAT of 6 million, and it was born to use from from February 2022, and they depreciate everything over 40 years. So they used the cost excluding VAT. Is that correct? Well, sort of. What's the issue again here? This is the admin building. So where they do all their admin. So how much VAT could they claim? Only 90%. So 10% of the VAT should be included. So this should be for section 13 quin. It should be 4 million plus 600,000 times 10%, 60,000. So that's the amount that you couldn't claim, times 5%. Again, guys, remember what I'm trying to say here is the total that you would have paid is 4.6 million. How much input tax could you claim? You could claim 600,000 times 90%. Okay, so you could claim 540,000. So that gives you 4,060,000 as your cost. So this is what you use for section 23C, so for income tax. Okay. Then we have note number 11. We've got salaries and wages of 15 million rands and trading stock distributed 500,000. Now already this worries me a little bit because when you distribute trading stock, section 22.8 tells you that there is a recoupment that you have to calculate. And that recoupment means the amount must be added. So this is a deduction. So that already worries me a little bit. Let's go and see. Stripes paid 15 million rands in salaries and wages to employees. Okay, what did they do there? They deducted it. So that appears to be correct so far. The company also distributed trading stock to employees as a fringe benefit. The cost of the trading stock distributed to employees was 500,000. Okay, so that's that amount that they deduct there. And the market value was 650. The cost of the trading stock was correctly included in the opening inventory figures in Note 2. What was Note 2? Oh, so this was this opening inventory. So they already claimed a deduction for it. So this here is incorrect. Because the deduction has already been claimed on the opening stock. What should they be doing? Section 22.8 says you recoup market value except if it's private use that's been distributed. Now remember, that is only for sole traders if they take their own stock home for private use. If you give this trading stock to an employee, the employee isn't the person who originally owned the stock. The company did, Stripes did. So yes, the employee might use it for private use, but that's not what Stripes is not using it, the company. Private use, and if there's a Section 18A donation, so donation to PBO, basically. Then you use, well, usually cost. I'm going to just say a cost, but you actually use the amount previously deducted, okay, which is usually cost. So they didn't do that. They need to have the Section 22.8 recoupment of market value here, and they haven't done that. What is that market value amount? Note 11, 650,000. Okay, then we've got note number 12. A patent, there's a decrease in the capital value, and they've had a capital loss here of 85,000. Okay, 85,000, so they put it in the CDT column. Okay, so let's see. So the only time you could have that capital loss is if you actually had a disposal and you had a capital loss. So they say, Stripes purchased a patent in 2005 for 500,000. The patent allows them to manufacture freezers that use a greater amount of electricity to flash freeze food. This patent is being amortized over a period of 30 years. Okay, so we don't do anything with that for tax. Due to the world's shift towards cleaner technologies, there has been a decrease in the demand for appliances with high energy demands. Stripes' management reviewed its patents and found that the recoverable amount for the patent was 85,000 rands less than the carrying amount. So they calculated an impairment loss. So that 85,000 is an impairment loss, and that is not allowed for tax. What is also missing here? Section 11 GC, you can get a 5% allowance. So it should be 500,000 times 5%. Okay, so where is that? So this 85,000, not allowed. Okay, then we have note number 13. So it looks like there's quite a lot of things happening here. Let's see. So the first thing is there's trading stock destroyed of 250,000 as a deduction. Okay, let's see. There's an insurance claim. So there's something went wrong, you can see, and you received an insurance reward of $1,040,000. There's a recoupment that was calculated here of $1,040,000. Now already I can see an issue here. What's the issue here? This cost of the machine was $850,000. So the total allowances that they calculated here was $850,000, because you can see the tax value is null. You can also add it up. So the first thing is that this recoupment over here exceeds the past allowances. Which is a problem. The next thing I can see is that this 2022 deduction over here should be deducted over here as well. Otherwise, you haven't taken it into account. So there's a couple of things already popping out. Did you see them? Okay, so let's see. On the 1st of July 2019, Stripes purchased a second-hand manufacturing machine from Mr. Lewis who was not a VAT vendor for 850,000 rands, and they brought it into use immediately in the manufacturing process. Okay, so two things that's wrong that I can already see then. There's 850,000, right? We'll talk about that in a second. The first thing I want you to see is they used 40 here. 40, 20, 20, 20. This is a second-hand machine. So for section 12C, it means you use 20, 20, 20, 20 over 5 years. So that is wrong. Then that 850,000 rands there. Okay, what's that 850,000? It is the cost of this second-hand machine which they bought from a non-vendor. Okay, so total cost was 850,000. Could you claim input tax? Now think about the VAT invoice here. This is the VAT invoice that you would receive from this Mr. Lewis. It would say cost X VAT 850,000. It would say VAT on it. What's the VAT? Nil, because Mr. Lewis is not a VAT vendor. So the total would be 850,000. So yeah, it almost seems like they're correct there, because there is no VAT on the VAT invoice for them to claim. Remember, we only claim VAT from the VAT invoice, except for second-hand goods, where you can claim notional input tax on second-hand goods. So how much could you claim? You could claim 850,000 times 15 over 115. Remember, it's always times the fraction. You always treat it as if there is VAT on it. So 110,870 gives us 739,130. So this is what the cost should be. This is the cost for income tax. So they've been wrong in the past already for calculating that on that 850,000. Okay, so let's continue and go back. So that's that first part. Then they say a fire broke out in the factory on the evening of the 5th of July 2022, and the machine, together with a few items of trading stock, were destroyed. Stripe submitted an insurance claim, and the following amounts was deposited in the company's bank account. Machine stock, 1,040,000. Okay, so already we see a couple of issues here. The first thing I want you to see is that if I take you back, they calculated the recoupment on that insurance award of 1,040,000. But that 1,040,000 over there is the machine plus the stock insurance claim, which is wrong. You can only use it for the machine. So they were wrong to use 1,040,000. They should have only used the 720,000. Plus then the 720,000 rands. This is the amount deposited into the company's bank account. So they should use the amount excluding VAT. Right, that's the first thing. Then the stock, same thing here. The stock should be 320 times 100 over 115. So 278,261, and that amount should be included in gross income. Why? Because it fills a revenue hole. That is what that one court case told us. So if you receive an insurance, for a capital asset, it's capital. If you receive an insurance for trading stock's not capital. It should be included in gross income. So there should be an amount included here. They've got this 250,000 rands as a deduction there. Now what is that 250,000? As they tell us, is the cost of the trading stock that was destroyed and it was included in opening stock. So that's again wrong. That 250,000 rands there is wrong. It's already deducted. Because it was deducted in note number 2 when they did this calculation of cost of sales. It was deducted here under opening inventory. So you can see that's a mistake. Okay. Then note number 14. Okay, quite a lot of things happening here. So let's go and see. So they've got an imported machine, calculation of cost, customs duty value, import duties, VAT. Okay, so already, if I'm seeing that, I would be concerned about the use of customs duty value, because that is just the value used by the customs duty people to calculate your import duties and your VAT. I would be concerned about the potential inclusion of VAT there, because yes, there's output tax when you import something, but you could claim that. Right? And then we've got section 12C, we've got Forex, which they calculated as the actual cost of the machine less the expected cost of the machine. Right, they gave them a Forex loss. Alright, I'll have to see what's happening there, if that is correct or not. So it says, on the 1st of February 2021, Stripes signed a contract. So just make sure you see, that's in the previous tax year. Stripes signed a contract with a supplier in the USA to purchase a new sheet cutter, a machine which would be used in Stripes' manufacturing process. The machine cost $180,000. The machine took 4 months to build and was ready for shipment on the 31st of May 2021. Still prior year. Due to unforeseen delays on the supplier's side, the machine was only shipped FOB on the 18th of July 2021. So the 18th of July over here is the transaction date. So that's when we calculate our first, or that's our first point. That is what the cost of the asset will be calculated on. The import duties amounted to $150,000. The South African customs officials assigned the machine a customs value of $3 million. Remember, that's what they used in the daily law calculation. The output tax was calculated as $3 million, which is the customs value, fine, plus 10% of the $3 million, fine, plus $150,000. Right, so that's correctly calculated. But you could claim that. And they tell you Stripes paid the customs duties and VAT on the 28th of September 2021. This is still in the prior year, and the machine was delivered to the factory in Born to use on the 4th of October. Current year. Okay, so immediately you should see here that they purchased this asset in the previous year, but it was only born to use in the current year. So thus, section 24I7 should apply. What does section 24I7 tell you? It tells you everything from the past. The forex gains and losses must only be taken into account in the year when the asset is brought into use. And then they tell you Stripes settled the outstanding debt of the supplier on the 1st of November 2021. Okay, so there's now a couple of things here. So the first thing is, the 30th of September over here is the translation date. And the 1st of November over here is the realization date. So this forex gain or loss here from the prior year must only be taken into account in the next tax year. So this forex must be taken into account in terms of section 24I7 in 2022. This is the forex for 2022. Okay, so let me just restate that here to make it a little bit clearer on showing. But again, you should know this by now. But this is the Forex for 2021. Take into calc in 2022 due to section 24I7. Now, what would we calculate this cost of this machine? How would we calculate it? The cost of the machine would be the cost, and the cost of the asset is $180,000. So 180 times what exchange rate, guys? Times the transaction date exchange rate of 1435. So 2583. You would then also add the import duties, because that is a part of the cost of the asset. The import duties were 150,000. Then there's output tax. So I just want you to see, I'm going to just show you like this. The output tax is this amount of 517,500. But you would claim that also as input tax. So the net effect there is null. So that's why we just usually exclude it from the calculation. So it gets us 2733,000. That's the cost. Okay, so let's just quickly go and see now. So the first thing is this cost is wrong. Section 12C, they take that cost, okay, which is wrong, fine, times 20%. Is that correct? No. This should be 40% because it's a new machine. And this is the first year of bringing it into use. Then the Forex, they calculate the Forex as the actual cost of the machine. So 180,000 times 15.11, which is what? Okay, so this is price I paid on the 1st of November. Less 1315. What's 1315? 1315 is this, on the 1st of February, when they entered into the contract. Because they thought that's what they expected to pay. So is that correct? No. They should do this Forex year for 2021. They should have done it in 2021, yes. But it should only be taken into account now because of Section 24I7. And then they should do this Forex between the translation and the realization date. So those are all mistakes that they've made. Okay, then number 15, we've got here a current year expense and a prepaid expense. Current year expense is deducted, and the prepaid expense is set deductible in the next year. Okay, so let's go and see. It might be correct. So this is the current year one. They say Stripes rents a warehouse where it stores its trading stock. Stripes pays the annual amounts relating to this warehouse in advance each year. So again, what I want you to see, what's important here, is that this has nothing to do with the rental accommodation, so you could claim all of that. The table below shows the amounts which relate to the current financial year, as well as the amounts which have been prepaid. The table also shows you how many months have been paid in advance. Okay, sorry, that word just needs to be out. So we've got warehouse rental, security, and insurance. This is the total excluding VAT. That's fine. We should use the total excluding VAT because they would be able to claim the VAT. This is the current year amount. They've claimed as a deduction. And I agree you can claim it. Then section 23H says, this is for prepaid expenses. Everything which is 6 months or less, you can claim immediately. So you should be able to claim this. Can claim as 6 months or less. It's not exceeding 6 months. That's fine. Everything else that is more than 6 months, these two, you need to add up. And if that exceeds 100,000, then you can't claim it. The sum here is 98667. So thus does not exceed 100,000. Thus can claim. So you can claim this whole prepaid balance in advance. Remember, the fact that that top one there exceeds 100,000 rands is not the issue. It's only for those which are more than 6 months prepaid. So if we go out to the calculation, they're correct to say the current year expense, but they should be able to claim here. Can claim. Then number 16, sale of land. We've got proceeds. There's base cost is a capital gain. Then they take the capital gain here, 700,000. They add up that one we had previously, okay, which we know is wrong, but let's just see what they've done in the calculation. They multiply that by the inclusion rate of 80, and then under note 17, they deduct a capital loss brought forward. Now, first thing I want you to see, and this is something which I actually often see in student solutions, is that this is wrong. The order here is wrong. You should add up all of your capital gains. It should be the aggregate capital gain less any capital loss brought forward. That gives you the net capital gain. And then you apply the inclusion rate of 80%, and that gives you the taxable capital gain. So here the order is wrong for these two amounts. The order is wrong. Okay, so let's see the sale of land. 1.5 million minus 800,000. And then note 16. Stripe sold a vacant piece of land in October 2022. The company had originally purchased the land in 2010. Alright guys, sorry, you'll see I'm going to just change this in your question also. It should be 2021 by the time you see it. So I want it to be in the current year. The company originally purchased the land in 2010 with the plans of developing it as a new site for the factory, but the area had become undesirable and the company had forsaken its plans. The land was sold for 1.5, so that's what they used for proceeds, and originally cost 800,000, which they used as base cost. That's correct. Right, and then note number 17, the company had an assessed loss of 130,000 carried forward. So they've done this calculation correct, and the issue lies over here. So again, just ignore that October 2022, which you saw in when I read it just now. Yours will say it correctly. Alright guys, that's it for this scenario and most of our discussion. In the next video, we'll just start wrapping it all up.